The Federal Reserve has gotten the blame for boom and bust cycles when they manipulate the currency, when they manipulate the amount of currency in circulation. And they do that typically. They have two key tools. One is to raise or lower the interest rate, and the other is quantitative easing, where they're putting all these extra reserves out in the system. The idea of lowering the interest rate is to stimulate the economy, because more people then borrow, and of course 95% of our money supply comes from banks when they create loans. So if more people are borrowing, that means they've got more money in their pocket, and they go out and they buy stuff, business booms, etc. So then you have a boom. Typically when prices get too high, the Federal Reserve wants to cut inflation, and the way they do that then is to raise the interest rate, which makes it more difficult for people and businesses to borrow, which means there's less money circulating in the economy. And then if it's very sudden, it can crash.
We've been fooled into allowing them to create a debt-based economy. And that means that for every dollar that comes into existence, in the United States, for instance, it's being loaned into existence by the banks. And then they're going to be collecting interest on that loaned money, either from individuals or from the government, from taxes and so forth. And they'll never print enough money to pay that interest. So all of society is thrown into that very crisis that I was describing for the individual. And that's why the government gets together every 6 months or so and makes a show out of worrying about increasing the debt ceiling. And they go, okay, well, we'll do it.